Welcome back to the Deep Dive. It is Wednesday, February 18th, 2026. And I have to be honest with you, I opened my portfolio app this morning, saw the sea of red, and just immediately closed it. It is ugly out there.
It's definitely a rough morning for anyone watching the charts minute by minute.
It really feels like the sky is falling. I mean, Bitcoin is struggling, the charts look weak. But then I look at the stack of research you sent over for today, and it's a completely different story.
It is.
It's like we're looking at two different worlds.
That is exactly the theme of the day. It's a tale of two markets. On the surface, if you're just looking at price action, we are seeing some serious weakness. It looks like a breakdown. But if you pop the hood and you look at the regulatory filings, the banking charters, the corporate moves, it's arguably the most bullish infrastructure day we've had in, 6 months?
So the price is reacting to right now, but the plumbing is being built for the next 10 years.
Precisely. We are witnessing a structural decoupling. The price is doing one thing, but the rails of the financial system are doing something else entirely.
Okay, well, help me feel better about my portfolio then.
Yep.
We have a lot to get through. We need to figure out why Bitcoin couldn't hold that $68,000 line.
For sure.
We have to talk about Stripe getting a massive win from the federal government.
The huge what?
And there's a fight brewing with the CFTC, and then some serious drama with Peter Thiel dumping a major crypto stock.
And we absolutely have to talk about the DeFi thesis at the end, because while Bitcoin is just chopping sideways, the application layer, the actual software is, it's printing money.
All right, let's unpack this. Let's start with the part that hurts, the market intelligence. We're looking at Bitcoin breaching that psychological $68,000 support level. I think we hit a low of, 66.5?
We bottomed out around 66,557 before bouncing back a little to settle near 67,700.
So what's driving this? Is this just retail panic, or people just waking up and selling because they're scared?
No, see, that's the misconception. This doesn't really look like retail panic. Retail panic is usually chaotic, noisy. This looks more like directional exhaustion.
Directional exhaustion. That sounds like a fancy way of saying everyone is just tired.
In a way, yes. The passive institutional buyers, the big funds that just blindly buy every single day, they've stepped back. They've paused.
And when the buyers step back,
the market gets dominated by algorithmic selling, robots.
So the bots are just pushing it down.
Well, when those key support levels break, the algorithms trigger automatic sell orders. It's completely mechanical. And we are seeing the evidence of that institutional pause in the ETF flows specifically.
Right. I saw those numbers. They were pretty grim.
Wow.
Total net outflows from U.S. spot Bitcoin ETFs were over $100 million yesterday.
104.9 million, to be exact. But I want you to look closer at who is selling. This is where it gets fascinating.
Okay.
It wasn't everyone.
Break it down for me.
BlackRock's IBIT, the absolute giant in the room, it saw the heaviest bleeding. They had nearly 120 million in outflows.
Wow.
But Fidelity, Grayscale, they actually saw small inflows.
Wait, that's weird. Why would BlackRock investors be hitting the eject button while Fidelity investors are buying? I mean, aren't they the same kind of people?
Usually, yes. But this specific divergence, it indicates a risk reduction mindset among the largest, most macro-sensitive players.
So the biggest of the big are pulling back.
Exactly. And to understand why they're de-risking, we have to look outside of crypto. We have to look at what just happened in Geneva.
Geneva. You mean the diplomatic talks, the U.S. and Iran?
Correct. The talks between the U.S. and Iran.
I saw the headline, but I didn't think it was that bad. I mean, they didn't walk out, did they?
They didn't walk out, but they didn't really agree on anything either. The talks ended yesterday inconclusively. They agreed on some guiding principles, which is just diplomat speak for, we agreed to keep talking later.
No treaty, no binding resolution.
Nothing. And markets hate uncertainty. And while those diplomats were shaking hands, the reality on the ground escalated. The IRGC was conducting live missile drills in the Strait of Hormuz.
That is never a good sign.
And now there are reports of fortification at the Taliban 2 nuclear facility.
Taliban 2, I haven't heard that name in a while.
It's back on the radar. And here is the key insight for you and for anyone wondering why their Bitcoin is down today. Bitcoin is currently failing the safe haven test.
That's the whole narrative, right? Digital gold. When the world goes to hell, you buy gold and you buy Bitcoin.
That's the theory. But right now, the reality is that Bitcoin is trading like a high-risk tech stock. When investors see potential conflict in the Middle East, they get scared. They don't run to Bitcoin, they run away from it.
They sell their most volatile assets first to get cash.
Exactly. That is why we are seeing this price weakness. It's a liquidity event, not a fundamental failure of the asset.
Okay, that makes sense. It's behaving like a risk asset, not a safety net. So the price is reacting to the scary headlines. But while everyone is staring at that red chart, you said something massive happened in the regulatory world.
This is arguably more important for the next 5 years than the price action is for the next 5 days. We need to talk about Stripe, and specifically their subsidiary, Bridge.
Stripe is everywhere. I feel like I use them 10 times a day without even knowing it.
You do, and they just got a huge nod from the federal government. Bridge received conditional approval from the Office of the Controller of the Currency, the OCC, to form a national trust bank.
A national trust bank. That sounds incredibly boring and official. Why should I care?
It is boring, and that's why it's so exciting. In the crypto world, boring means safe. Here's why it matters. Up until now, if you wanted to move crypto or stablecoins across the U.S., you had to deal with the absolute nightmare of state-by-state money transmitter licenses.
Oh, well, like getting a license in New York, then another one in California, then Texas.
Exactly. 50 different permissions, 50 different sets of rules. It's a complete mess. A national charter cuts through all that red tape. It's the federal government basically saying, you are good to go nationwide.
It's like the U.S. government is inviting stablecoins into the main banking hall.
That's a great way to put it. But I'm looking at the notes here, and it mentions they are complying with something called the Genius Act.
Great name, right?
It's a little on the nose, but sure. What does it actually force them to do? This is the critical detail. The charter explicitly prohibits fractional reserve lending.
Okay, let's pause there. Fractional reserve lending. Can you explain that like I don't know, 12?
Sure, okay. Traditional banks, like the one you use for your checking account, they practice fractional reserve banking. You deposit $100, the bank keeps maybe $10 in the vault and lends out the other $90 to someone else.
Right, to buy a house or a car. And they make money on the interest.
Correct.
Right.
And if everyone asks for their $100 back at the same time...
The bank collapses. That's a bank run.
Exactly. Now, this new charter for Stripe says you cannot do that. If you hold $100 of a customer's stablecoins, you must have $100 of liquid cash or government treasuries sitting in the vault, 1-to-1.
Ah, so no lending it out to hedge funds.
No. They are solving that duration mismatch problem that everyone talks about.
Right, which is just a fancy way of saying don't lend out money for 5 years that your customers might want back in 5 minutes.
That is what blew up Celsius. That is what blew up Voyager. They took instant deposits and made long-term risky bets. This OCC charter effectively bans that business model for stablecoin issuers.
So this paves the way for what we'd call enterprise-grade digital dollars.
Correct. If you are a massive corporation, say Walmart or Amazon, you are never going to use a stablecoin issued by some offshore startup where you aren't sure if the money is actually there.
Yeah.
But a stablecoin issued by a federally chartered national trust bank owned by Stripe, that is infrastructure you can build a global business on. It legitimizes the whole concept.
It's like the adults have finally entered the room. Speaking of adults entering the room or maybe kicking the door down, let's talk about the CFTC.
Commodity Futures Trading Commission.
They are getting aggressive. We've got a jurisdictional war breaking out over prediction markets.
We do. The CFTC has filed an amicus curiae brief, essentially claiming they have exclusive jurisdiction over prediction markets. You know, platforms like Kalshi and Polymarket.
I've seen these. People bet on election outcomes, Fed rate cuts, even pop culture stuff. I mean, usually that's considered gambling, isn't it?
Historically, yes. If you bet on an outcome, that's gaming. That's regulated by the states, Nevada, New Jersey, and so on. But the CFTC is coming in with a very interesting argument. They are saying these aren't bets.
Okay.
They're event contracts. They classify them as swaps. They are using the Dodd-Frank Act to say if you are trading a contract based on a quantifiable event, that is a financial derivative. It's a financial product, and if it's a financial product, it belongs to us.
So they want to turn Polymarket into the New York Stock Exchange.
Essentially. And not everyone is happy about it. Senator Elizabeth Warren issued a pretty stinging public rebuke yesterday.
What's her angle on it?
She argues that this is just a loophole, that calling it a swap is a fancy way to shield unlicensed gambling platforms under the guise of financial innovation. She wants them restricted by gaming commissions, not legitimized by financial regulators.
Okay, play this out for me. If the CFTC wins this, If they actually get control,
Hmm.
what does that mean? Is that good or bad?
It's a double-edged sword, but I'd say mostly bullish for the infrastructure. Think about it. If these are federally regulated derivatives, it legitimizes the underlying technology. Specifically, it legitimizes decentralized oracle networks.
The oracles.
Yeah.
Those are the things that feed real-world data to the blockchain, right? To tell the contract who won the election.
Exactly. You need a reliable, neutral referee. If the CFTC regulates this market, they are implicitly validating the need for that oracle infrastructure. It opens the door for Tier 1 institutional liquidity to enter because now it's a trade, not a bet.
That is a fascinating distinction. It turns a casino into a regulated market. Okay, let's pivot. We need to talk about the corporate world because we saw a major exit yesterday involving a very big name, Peter Thiel.
The legend himself.
His firm, Founders Fund, has completely bailed on ETHZilla.
And for people who haven't tracked this stock, ETHZilla is the nickname for that biotech firm that pivoted to just holding Ethereum.
Right. And Founders Fund executed a total divestment, 100% of their stake. They are out.
And the stock is down, checking my notes, 97% from its peak.
97%. It's a catastrophe, an extinction event.
So why did Thiel pull the ripcord now?
I think this really marks the death of the proxy model.
The proxy model. Explain that.
So go back a few years. If you were a fund manager and you wanted exposure to crypto, you couldn't just buy it directly. Compliance wouldn't let you.
Mm-hmm.
So you bought stocks of companies that held crypto. You used them as a proxy. You even paid a premium for them because it was your only option.
But ETHZilla wasn't just holding ETH, were they? No, and that's the key. They were a leverage proxy. They issued debt to buy Ethereum. They borrowed money to gamble on the price going up.
And when the price dropped.
They got squeezed. They were forced to sell their Ethereum holdings just to pay back their debt. It's a value destruction spiral. They are selling the very asset they're supposed to be holding just to stay alive.
So Thiel looks at this and says, why am I doing this?
Exactly. Why am I holding this risky debt-laden company when I can just buy a spot ETF now? The ETFs killed the proxy model. There's no reason to take on all that management risk anymore.
So the ETFs made these companies obsolete overnight, but not everyone is fleeing. We have a company called Hyperscale Data doing something that feels, honestly, kind of archaic. They're buying silver.
100,000 ounces of physical silver.
Physical silver, like bars in a vault. This is an AI and Bitcoin mining company, right?
It is. It feels very 19th century, but it's actually a very modern strategy called risk parity.
Risk parity. Okay, break that down.
So Hyperscale Data's business is heavily exposed to digital assets and tech volatility. If Bitcoin crashes, their stock crashes. By adding physical silver, they are dampening the volatility of their treasury.
Because silver doesn't move the same way Bitcoin does.
Right. They don't always move together. Sometimes one goes up while the other goes down. By holding both, you smooth out the ride. It's just diversification.
So they're building a hybrid treasury, digital scarcity plus physical scarcity.
Exactly. It shows maturity. They aren't just betting the farm on number go up. They are managing a balance sheet like a real financial institution. It suggests the next wave of corporate adoption won't be pure Bitcoin maximalism.
That is a really smart take. It's less Moon Boy and more CFO. Which brings us to our final segment, the DeFi thesis. With Bitcoin's price stalling, is the action just moving elsewhere?
Matt Hugin seems to think so. He's the CIO at Bitwise, and he put out a very important memo yesterday. His argument is that DeFi, decentralized finance, is going to lead the market out of this crypto winter.
That's a bold claim when the king coin is down. What are his receipts?
Well, the numbers are pretty undeniable. Look at Uniswap. It's a decentralized exchange just code on a blockchain. Its trading volume is now frequently surpassing Coinbase.
Wait, really? A piece of software is doing more volume than the biggest publicly traded crypto exchange in the US?
Yes. And look at Aave, the lending protocol. It's generating over $100 million in annualized revenue.
Okay, that's real cash flow. That's not just governance hype.
And that is the key shift. These protocol tokens are evolving. In the last cycle, if you bought a DeFi token, it was usually a governance token. It gave you the right to vote, but not a share of the profits.
So it's like having a voting share in a company that doesn't pay dividends.
Exactly. But now, protocols are voting to direct that revenue back to the DAO or to use it to buy back tokens from the market. They're becoming yield-bearing assets.
So they're starting to look more like regular stocks.
Precisely. They're starting to look like equities.
Yeah.
And that speaks the language of Wall Street. You have BlackRock and Apollo, these massive asset managers, now investing directly in DeFi tokens.
They aren't just buying Bitcoin.
No. They're looking at these protocols and applying PE ratios. They are running discounted cash flow models, DCF models. They are analyzing them exactly like they would analyze Apple or Coca-Cola.
That feels like a huge mental shift,
Yep.
separating the application layer from the Bitcoin settlement layer.
It's critical. Bitcoin can be flat, Bitcoin can be boring. But if people are using a VAV to lend and borrow, a VAV is making money. A VAV has value independent of Bitcoin's price action.
It's the difference between investing in gold and investing in a bank. Gold just sits there. A bank generates fees.
And institutional investors love fees.
Yeah.
They understand cash flow. They don't always understand digital gold, but they definitely understand a 15% profit margin.
Okay, let's bring this all together. It's February 18, 2026. The price is down, geopolitical tension is up, but the machine keeps building. What does this all mean for the person listening right now?
If we synthesize all this, we're seeing a massive stratification. Bitcoin is acting like a risk asset. It's weak because of geopolitics and exhaustion. But the plumbing, the stablecoins via the OCC charter and the applications, the DeFi yields, are rapidly maturing.
So for the learner listening today, what's the takeaway?
The takeaway is that the market is becoming less about hype and more about utility. It's about cash flows, federal charters, and risk management. The days of buying a random ticker and hoping for a moonshot are fading. The smart money is looking for infrastructure that fits into the federal banking system and protocols that generate actual profit.
It sounds like the industry is finally growing up.
It is. It's entering its industrial phase.
So here's a final thought to chew on. If institutions are selling the Bitcoin ETF, like we saw with BlackRock, but they are buying the infrastructure, like stablecoin banks and DeFi protocols, are we seeing the end of Bitcoin's dominance as the only metric that matters? Are we watching the rise of a utility-based economy right before our eyes?
It's the most important question in the space right now. I think the answer might be yes.
Something to think about while you watch the charts today? Thanks for taking the deep dive with us.
See you next time.